Hello and welcome to our first live policy roundup from Global Alts Miami, presented by iConnections and MFA. I'm Noah Theron, MFA's head of global external affairs, and I'm joined by my terrific colleagues, Jennifer Hahn, our chief legal officer and head of global regulatory affairs, and Jillian Flores, our chief advocacy officer. So Jillian, I'll start with you. We are in an interesting year. It's an election year, and there's quite a lot going on in Washington and around the world. So what are MFA's big themes for the year?
First, how fun to get to do this here in Miami today. 251 days between now and the election. So a lot of the focus in Washington is really driven by electoral politics. The Republican administration wants to keep control in Congress, and Democrats think they have a way of taking at least some control in Congress. So the balance of power is really at stake, and that kind of overarching mood and motivation is impacting a lot of what Washington will do here throughout the course of the year. Now, what matters to MFA? Of course, we are coming out of a prior administration in which we had a really, really problematic regulatory environment. A lot of rules that were promulgated that don't serve the industry's needs, they don't serve investors' needs, and we have the opportunity now to get rid of those bad ideas to kind of remove that regulatory overhang. So a lot of time spent at MFA about really reforming rules that didn't work, getting better rules in place. Another big theme, of course, a lot of attention on the industry for a lot of good reasons. Washington's talking about expanding access to alternatives. It's a really important narrative that is manifesting particularly at the Department of Labor, who's set to propose a rule to allow for alternatives to be better incorporated into 401k plans. Now, all that attention also is double-sided. It brings enhanced scrutiny to the industry. So attention around liquidity, valuations, other dynamics about alternatives. Policymakers are thinking about those and even thinking about the financial stability implications of hedge fund leverage or private credit, for example. So those are a couple of the key themes that we're working on this year, both opportunity and some risk as well.
Yeah, so it's certainly going to be a busy one. And Jen, I wanted to talk a little bit about what Jillian mentioned right off the bat, which is our effort to reduce regulatory overhang. Nowhere is that effort more active than at the SEC and CFTC. So what are the big ticket items that you're thinking about right now?
Sure, and I think touching upon what Jillian has said, so the SEC, the CFTC, the agencies are very aware that time is ticking. And so they are very aware there are midterms coming, and this could certainly impact their resources. So they're looking at their agenda, starting with SEC and CFTC. SEC, they have some of the things that they want to achieve: capital formation, IPO. And so here we're looking at a lot of things such as Reg SK, reporting, and how they look to eliminate some of the unnecessary items, to streamline reporting to help with capital formation, IPOs, registration in this sense, quarterly reporting. And these are all efforts that MFA will be engaged in. We're also looking at some of the trading and markets issues. And so certainly there, as Jillian mentioned, just as things have changed, looking at retailization, they're looking a lot at 24/7 trading, a lot at crypto. Crypto is probably one of the biggest topics among regulatory agencies, among the administration. And so we think regularly everyone's wondering, where are the rules coming? What's going to be happening with tokenization? So these are efforts MFA is also very dialed into. Just certainly with our members, for our members, we want to make sure that these markets, as they evolve for tokenization, trading of securities that are tokenized, that our members are able to participate in a way that is fair and efficient for their investors. And so we're looking at the market structure. I think we've been very appreciative to hear that the SEC and CFTC, as they're working together, they're also thinking about how rules can be harmonized. So to ensure that you don't have what's happened in the past, which is where you have, for example, securities futures and you have different regimes, and the regulatory hurdles have been so high that there just hasn't been development of the industry. So here the SEC, CFTC, they've agreed to work together. They're going to try and reduce redundant regulation. They're going to look at substituted compliance. They're going to look at joint rulemaking. And I think also for MFA, this is really important because we have our own initiatives. We want to reduce redundant, duplicative regulation. So that's for our CPOs, our registered investment advisors that are also CPOs. And so we're working on that for our no action relief that we receive to be codified and permanent. And then finally, I should say Form PF, of course. Form PF is something we've had significant efforts on. And then I think, jumping back to capital formation, there's also, Reg M, Rule 105, and how we can enhance trading efficiency for our members and capital formation at the same time.
Yeah.
Just to build on that, the spirit around capital formation is at the agencies as well as Congress, and it's a few different things, and I think all net helpful, but also politically motivated in many cases. It's about talking about how to get companies a better chance for success. It's about talking about how to get investors better opportunity, and it's reflecting a worldview that both public markets and private markets are really important. So I flag that because I think there is kind of an electoral politics dynamic that could energize the capital formation debate as policymakers around the country are trying to go back to their districts and really sell what they are doing to make their economies, their local economies better.
Right. I think that's been super clear with this administration, with this agency, which is very much pro-innovation, looking at rules and how to allow for flexibility. I think tokenization is one area where the SEC has said, look, we are going to allow for some room for innovation. But at the same time, they're not going to have huge exemptions where you have, you just kind of blow through U.S. securities framework and what's been really great for our capital markets.
Yeah, and I want to dig in a little more on Form PF because that is a form that was instituted after Dodd-Frank, and it was originally meant for systemic risk reporting. But under former chair Gary Gensler, that form doubled in size. And it seems like there is a willingness on the side of the SEC to, in fact, reduce the regulatory burden on filers without also, disadvantaging the SEC somehow, in terms of the data that they get.
I think that's true. I think under the last administration, unfortunately, there was not a lot of discipline and it was a huge gimme, gimme, gimme. And so a lot of questions were added to Form PF. I think the most egregious is really the way that the information needs to be collected. So they wanted to disaggregate. And so rather than really aggregate in your reporting across your funds or your strategy to one, they want to look at account by account. And so it not only have they doubled the size of the form, but now you have to file multiple forms. And so it's really costly. It has moved away from systemic risk. There are a lot of questions which are under the investor protection. And I think especially with the success of our lawsuit, the private fund advisor, there is less credibility in the ability that you need this, given what the courts have said with sophisticated investors and private funds are exempt from regulation. They're not to be regulated like mutual funds under the Investment Company Act. So we really think there's a great opportunity to right-size this form, to really help regulators collect the information they need for assessing systemic risk, whether that's hedge funds, private credit funds, private equity, without all this additional items. So we think there's an opportunity. We've had a lot of conversations with our members. And again, we've worked closely with regulators in providing concrete recommendations as to how they should, we think that they should look at it. How does the industry assess systemic risk? So. Well, this is a joint SEC-CFTC effort.
Yes, and certainly it's, as you mentioned, the agencies are probably working together in a collaborative way that we haven't seen before. Jillian, I want to talk about alternatives in 401k plans because it feels like Washington is aflutter since President Trump issued an executive order directing the Department of Labor and other agencies to allow for more types of investments to be in 401k plans. This has been a long-running conversation about how to best help everyday Americans save for retirements. And our research even shows that when you add alternatives into 401ks, it not only helps performance, but also makes portfolios less risky. Where does that effort stand right now, and what is MFA doing to help shape the conversation?
Yeah, it's a huge topic in Washington, as you note, Noah, and it strikes me being here at Global Alts with over 1,000 allocators that are really looking at alternatives as part of their solution. And these are largely institutional investors, of course, that have long been able to use alternatives to better diversify their portfolios. And Washington has kind of caught on. So why is the end beneficiary of a pension fund in a better position for retirement than a 401k saver? This is something that needs to be solved. So the enthusiasm is certainly welcomed. DOL has drafted a rule from what we understand, and it is waiting for approval within the White House before it is released. Now, this rule probably will do a lot of things and try and please a lot of parties, but at the end of the day, what it's trying to be solved for is the current litigation risk that a plan sponsor bears typically prevents it from its willingness to incorporate alternatives into the plan lineup, even if it might otherwise be the best set of options for the end beneficiaries. So to help kind of dilute that litigation risk, if not outright remove it, we're expecting some sort of safe harbor which will be crafted, which provides kind of a roadmap of process and procedures that a plan sponsor can take to better assess and better incorporate different types of investments. MFA has been working with DOL, Treasury, Congress, the SEC, really across Washington with policymakers for a long time, emphasizing a few things. One is, let's not be overly and only focused on fees. Fees should be looked at in a broader context. Another is, let's stay as neutral as possible in terms of which assets, which strategies can be incorporated, and really leave that to the plan sponsor over time to determine what the right allocations are as, of course, industries evolve. And another is fundamentally the role of the fiduciary, an intermediary that really assesses what falls within, say, a target date fund and what percentage of said fund should be allocated to private credit, hedge fund strategies, and others, is an important part of the overall kind of safeguarding framework around it. So we're encouraged. We are excited to see the proposal. MFA will be working very closely with the government as it advances, and really important signals on how the entire industry can be better reflected and better appreciated by more investors and savers.
Jillian is exactly right on this part, on the litigation, and that has been a huge hurdle for plan sponsors. And so right now, there's actually a case that the Supreme Court has taken up, and that is Anderson versus Intel. And so again, it has to do with alternatives in ERISA accounts. And so MFA is certainly looking to provide a view and a voice to help the Supreme Court understand the benefit, the potential role of alternatives in portfolios.
And there's a lot of movement that is yet to come on this. We'll be sure to keep our members informed as DOL proposes their rule. And I should mention, MFA members have access to all sorts of different content behind our member paywall, including a lot of on-demand videos that talk about what's happening on these regulatory issues. Jen, I want to move to the tax conversation because that's often an under-discussed part of MFA's advocacy, but there's been some really key things that have happened over the last couple of years. Certainly getting through, the one big beautiful bill and ensuring member priorities, were preserved. But also this issue around 892 that's bubbled up, dealing with the ability of certain foreign investors to invest in private credit funds. What is 892, and where do things stand right now with that?
Yeah, certainly there is never a dull moment in tax, and you're right. Tax is actually plays quite a significant role and part of our advocacy program because of how important it is to our membership and their investors. So Section 892, this is a provision under the Internal Revenue Code, which has to do with the taxation of foreign governments. And so this will impact such as sovereign wealth funds, public pension funds, and others, which make up a significant portion of investment into U.S. businesses and the economy. So really important. This proposal here really gets at how what is taxed of those investors. And so there's always been a line between commercial activity and how that is taxed and passive investment. And so usually, generally, and it's been well established under regulatory practice and understanding of current statute and regulations, what is commercial activity and what is passive investment. So a lot of that passive investment, so as you've mentioned, private credit funds and other investments in debt instruments. So this proposal gets it pretty wrong, and it pretty much starts off with all debt investments are commercial activity with a few minor exceptions, such as publicly traded on a stock market. So again, this would really disrupt our industry. It would disrupt the economy, really harm a lot of jobs, businesses who would not be able to get the critical funding from private credit funds and other private funds that they need. So we've been working very hard on this. We've written a pretty solid letter. We have engaged with Treasury officials, and we're quite pleased that some of the early things that we've heard out of Treasury seem to be in the right direction, that they're not going to disrupt market practice. And certainly they don't want to discourage foreign investment in U.S. businesses, the U.S. economy.
Yeah, that's right. And Treasury has certainly been sending all the right signals that they plan to amend the rule. Jillian, one of our very important parts of advocacy is the focus on financial stability and systemic risk. Oftentimes, our industry is scrutinized by regulators for the things like the use of leverage, its connection to the banking system, and one of the things we do is engage with regulators all around the world to help them understand what our industry does, how it works, and why there's not a financial stability concern with the activities of hedge funds and private credit and other strategies. So where do things stand right now in terms of the global regulator focus on issues like financial stability?
Do you want the bright spots first, or should I get right down to the risk?
Let's go with the bright spots.
Okay, there are some bright spots. One is here in the U.S., the Financial Stability Oversight Council, the kind of super regulator of financial stability, has shifted its focus away from thinking of our industry as a problem toward certainly monitoring our industry, and certainly they will continue to have a lot of questions, but seeing it more as part of the solution and kind of refocusing those efforts. We're also working with Congress to statutorily change the authority that FSOC has so that a future administration cannot use FSOC to basically designate a non-bank under a bank-like regulatory framework as a SIFI. So that's something that is trending favorably. Another bright spot outside the U.S. and really around the world, inclusive of the U.S., we are in an era where key jurisdictions are focused on competitiveness, economic growth, simplification, kind of broader, quote unquote, deregulatory efforts in the UK, the EU. We're doing a lot of work in the Middle East with our members, setting up presences there, and it's a lot of opportunity. Okay, that's all the upside. Financial stability is really the existential question for the industry. As non-banks continue to grow the role, whether it is hedge funds in sovereign debt markets or private credit providing access to capital to businesses that might have once upon a time got that capital elsewhere, it raises a lot of questions to policymakers about how we're regulated. And there are a lot of examples outside the US in particular where the scrutiny around these practices, these parts of the industry, is only intensifying. We see that at the Bank of England, who's looking at its own sovereign debt markets and how to potentially impose additional regulation to account for hedge fund leverage in that market. We see it across the EU, thinking about stress testing non-banks and thinking of kind of prudential tools that it might impose on our members. And certainly across jurisdictions, the focus on private credit and its growth, while I mentioned earlier, a real bright spot, DOL is looking at that as part of the solution for everyday savers. The other side of it is immense scrutiny about the growth of private credit and whether its interconnections to the banking system could present any sort of broader systemic impact. There is almost an insatiable appetite for data across jurisdictions to get more information about what our industry does. Jen mentioned Form PF earlier. It's a compliance burden, but it's so much more than just a compliance burden. It's part of the solution to this data urgency that policymakers feel. So we will have many years ahead trying to educate and improve the worldviews of policymakers who see our industry as presenting risks that, frankly, we do not agree exist. So a lot of opportunity, but still, we're keeping our heads down and doing the hard work of ensuring our industry is well understood.
Yeah, that's right. And it's a big part of our research work stream are the issues around private credit and financial stability, hedge funds and financial stability. Well, thank you, Jen and Jillian. I hope you've enjoyed our first policy roundup from Global Alts Miami. We hope to continue doing these in the years to come. If you are interested in MFA membership, please reach out. We can be reached at memberservices@mfaalts.org.